You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 13th of June and I'm joined by my co-host John McEwen. And in this week's episode, we'll be discussing British Land Co, Sage, Ibstock, AutoTrader, M&S and Cranswick. We don't have a US company this week. So John, do you want to start us off with, a REIT that has increased in our estimations recently?
Yeah, no, absolutely. So it's one of the UK's biggest REITs. It's British Land Company. And essentially, when we first started the show, which was about 5 or 6 years ago, it was during COVID, and British Land had huge exposure to traditional office spaces. And then that was clearly massively hit by COVID with people working from home. And you wondered with British Land, where does it go from here? Well, I'll read the full year results out and then we'll have a chat about where it's gone and what we think about it. But their full year net rental income rose by 6% on a like-for-like basis to £476 million. That was driven by a 12% growth in campuses and a 2% uplift in retail and London urban logistics locations. The portfolio portfolio value, I should say, grew by 2% to £10.1 billion. And the loan to value ratio rose from 38.1% to 39.2%, reflecting increased development and spending. For the year ahead, like-for-like net rental growth is expected to be at the top end of the group's 3 to 5% target range, and the group expects earnings per share to be at least 30.5 pence a share, and that's against the 30.6 consensus. A final dividend of 10.8 pence a share was announced, taking the full year total to 23.12, which is up 1%. And the shares were broadly flat on the results. In terms of valuation, the group have a market cap of £4.28 billion and trade at 0.59 forward price to book, compared with the 10-year average of 0.68, and they have a prospective dividend yield of 6.5%. I thought these results were pretty decent, with a smart strategy with the group pivoting towards more growth-orientated areas like the sort of science-type campuses, the retail and urban logistics with the growth of same-day delivery. And there's also the role for data centres and the growth of AI. The net debt is around 2.4 billion. The REITs generally carry more of that, and obviously it's felt to be pretty solid in terms of the buildings that they own. I appreciate that was something that was upended a bit in COVID with the valuation of some of the offices that they had at that point. But I think what they've done since then has been really good, and the valuation is not very expensive. I think one of the issues a little bit when it comes to the growth of the AI and the data centres is energy costs in the UK. But certainly you do wonder if there were any change in energy strategy in the UK, i.e. to essentially bring energy costs down. That would certainly benefit British Land. And I think you probably see more growth in the UK AI. That's also quite relevant to when I come on to Ibstock later in terms of the energy costs. But overall, I think British Land is, on the surface of it at least, looks like a decent REIT. It's not one that I would have considered going back a few years, but now it's sort of creeping up there into potentially watchlist space. I think the difficulty for British Land, certainly when I'm looking at it, is that there are a lot of other very good REITs in the UK which also don't look very expensive. So I think that's one of the issues. I know in the financial press, there's been quite a lot of talk about the UK REITs getting a fair bit of attention from America and American private equity. So I think it looks, even to the sort of external American investors, particularly when the pound isn't particularly expensive, that there is value here. So yeah, I think there is certainly an investment case to be made. Sam, what are your thoughts on British Land? Is it creeping onto your watch list at all?
I wouldn't go as far as a watch list, but I think if I was looking to add a REIT, it's certainly one that would now be in the discussion, whereas I'd say of the kind of 5-6 years we've done the show, for 4 or 5 of them, it just wouldn't. I think they've done a really good job, like you say, sort of pivoting after COVID. I think it's interesting as well where it's priced below the 10-year average for price to book, because I would say compared to where it was kind of 5-10 years ago, I would say not only is it cheaper, but that book is kind of higher quality. I think probably my only niggle with it really would be that loan to value of 39.2, although it's probably manageable. It's fairly high for a REIT. It's not in a range where you'd be concerned about it, but if we compare it to some other REITs that we look at quite regularly, they tend to be hovering around 30-35% instead. So it's not a million miles out, but it is just something to bear in mind. I think it's interesting as well, and this in fairness will apply to most of the REITs that we cover quite regularly, but I think with like the renters reform and stuff, because it's all commercial, they've not really been impacted by that. Whereas if you compare it to when we covered Unite a few weeks ago, they just really seem to be having a tough time as a result. So yeah, I think it's a good set of results, and I think it's actually quite an attractive REIT. I think the only scenario where I'd probably seriously consider it was if I wanted more of a basket, but at the minute I've got Supermarket Income REIT, which I'm very happy with. I know you've got Primary Health Properties as well. I think if I were to add one, it's always Tritax has always been the one that's on the watch list for me. So, but British Land, I think, have done a really, really good job in the last few years.
Do you think if you were a bit older and later on in your investment journey, that this would be more appealing?
I think it would actually. If my portfolio was more geared to income rather than growth, I think, it's much more likely there would be a basket of REITs in there rather than just one.
Yeah.
So I think at that point it would look very attractive.
Okay, fine. What about Sage Group?
Yeah, so Sage, we've covered it. We've been covering it for a while, but kind of on and off. And then we've started covering it a bit more recently because it's been one of them companies that's been impacted by like the drop as a result of AI. The results have always been pretty good. The main niggle I've kind of had with it is because their software, so it's accounting software that they do, and it's always been kind of targeted at small and medium-sized businesses. As someone who works in the accounting sector, although I work in tax, in the firms I've worked at, speaking to colleagues, I've never been anywhere where, as a firm, everyone's really rated the Sage product. So that's always been my issue with it. So Sage have come out with their half-year results, and revenue was up 10%, operating profit was up 15%, and the operating profit margin increased 1% from 20.5% to 21.5%. Basic earnings per share was up 14%, and the dividend was up 8% as well. In terms of some of their own KPIs, annualized recurring revenue was up 11%. Total underlying revenue was up 11%. Total underlying operating profit was up 15%. And the underlying EBITDA was up 14%. And that gives an EBITDA margin of 27.6%, which is up from 26.8%. They've announced in 2026, in March 26, a share buyback program of 300 million, which is well underway. And that takes the total value of share buybacks announced in the first half to 600 million. And for context, that's on a market cap of 7.37 billion. So these are quite chunky buybacks. In terms of the operational highlights, they've said the renewal rate was by value 102%, which was ahead of last year, which was 101%. And that reflects higher sales to existing customers, including the growing adaptation of AI-powered features, supported by strong retention rates. So the AI-powered features is something they are talking about a lot in this report. I think it's quite interesting because we've probably noticed it in the last few weeks quite a lot with a lot of these sort of more techie companies where there's concerns that they'll be damaged by AI. They are very keen to push how many of their products are going to be supported by AI going forward. As an example, they've said they're embedding AI into core customer workflows with the launch of intelligent agents and the expansion of Sage Copilot, delivering tangible productivity and decision-making benefits to customers. Sage Business Cloud revenue increased by 15%, including cloud-native revenue growth of 25%. And in the outlook, they said they're building on strong momentum in the first half and now expect total revenue organic growth for the 2026 year to be above 9%. We continue to expect operating margins to trend upwards as we focus on efficiently scaling the group. And in North America, revenue grew by 14%. In UKIA region, which is a bit of an odd one because it's UK, Ireland, and Africa, which you don't normally see grouped together, but revenue increased by 10%. So what they're saying about us and the Irish, I don't know, but they've lumped us in with the third world anyway. And then in Europe, revenue increased by 7%. If we look at where that revenue comes from, so 616 million is North America, 395 million is UK, Ireland, and Africa, and 352 million is Europe. I should say that UK, Ireland, and Africa also includes Asia Pacific, but that's quite a small part of it. So it's a pretty well diversified business, and actually the biggest market by far is the US. In terms of the valuation, business trades at a P of 18.65 and has a dividend yield of 2.67%. But as mentioned, they are doing some quite chunky buybacks, so the actual yield's probably quite a bit higher. I thought these were a really good set of results. I can't see any huge impact from AI in these results. Where it goes going forward, I don't know, because I can see it being incorporated into the products, and the AI does kind of need data to go off. Whether there's going to be some kind of AI-powered alternative in the future, I don't know, but I find it quite hard to visualize. These products are very sticky. They'll be linked to the company bank account, so it's got all the transactions. And when you want to move over to another provider, you do tend to lose kind of years of data because you are starting from scratch. So it is quite a sticky product, even though, as I've said, I don't think it's necessarily the best product on the market. So yeah, I think a P of 18 and a half, I actually think it looks pretty decent, but it's just with that caveat that for me, I don't think I'd ever be seriously interested in it just because of that anecdotal evidence. And I know you shouldn't really rely on anecdotal evidence, but I think when it's anecdotal evidence that's probably going against a stock, I probably do prefer to rely on it, because if I bought it and it didn't perform, I would just be kicking myself. So yeah, I think these are a really good set of results, but it's just not one for me. What about you, John?
Yeah, I mean, I would agree. I think I do have AI concerns about it. However, with the numbers that it's still putting up, it certainly looks better value than it has done for years. But as you say, it's more a case of being wrong. And if we are wrong and it does really well, then it would have been a great time to buy it. But I just don't have the same conviction. Whereas I think with other companies that have been affected by this kind of rotation to do with AI, like your right moves, where it's very, very data rich, and you just can't, well, I can't see how AI would break or overcome their moat. I'd go with the investment case for that much more, whereas this is one that I probably wouldn't be brave enough.
Should we move then to a company that's got energy concerns instead of AI concerns?
Yeah, so it's sort of more old world concerns with this one. So it's Ibstock, which is the UK's largest brick maker. We've covered it quite a few times on the show before. It had a trading update out a couple of weeks ago now, with Ibstock's like-for-like revenues falling by 10% over the first 4 months of the year. Price increases more than offset by lower volumes. Higher energy and fuel prices have led to increased cost inflation, which is expected to continue into the second half. To help manage the impact, Ibstock has locked in prices for 80% of its energy requirements for the full year. The group expects to deliver full year results in line with current market expectations. And this points to a revenue declining by 2% to £366 million, and underlying cash profits falling by 4% to £68 million. And the shares were actually up about 2.5% in early trading. In terms of the valuation, the group have a market cap of £375 million. The shares are down 40% over the past year, and they trade at 18 times forward earnings compared to the 10-year average of 13.3, and they have a prospective dividend yield of 3.1%. I mean, clearly it's quite an easy one to understand. They're massively hit by rising energy costs and the drive towards net zero. There's also this compounds the demand side of it, with slowing housing market, with interest rates remaining higher, and that's looking like they're going to be higher for longer, with inflation coming back in. So lots and lots of headwinds. the argument always used to be that it's going to be much more expensive to import bricks. They're heavy, transport costs are high, but with the cost of energy in the UK, certainly compared with, say, the Middle East, for example, that it's so much higher that you get to a point where actually the economic argument may be disappearing a bit. They're limited with how much they can increase prices as a result, and you see that the volumes are falling off. That may be just a general market demand problem, but also their higher prices are contributing. So I think they're in a really, really difficult place. The valuation as well, it's I don't think it reflects quite how bad things are for the business. If you were to look at any tailwinds, I think it would be the hope that at some point in the near future, there might be a change in energy policy and there might be sort of supply side reforms to the housing market. But both of those things, I think, are probably quite some way away if they happen at all. So I think the near-term outlook for Ibstock is a really difficult one. So I certainly wouldn't be buying shares.
I would agree. I think the only sort of saving grace for it is that you're probably 3 years away from a change in government, but it's not the most compelling argument to buy a stock, is it? So it's just quite sad to see, really. I think as well, this is only a trading statement, so they've not got the full detail that we would normally have in the results. But last time the debt was creeping up as well, and they've not mentioned that. But based on these results, I can't imagine the debt position's got any better. So, and they like to talk about the EBITDA, but when the debt's pretty high and it's quite a capital-intensive business as well, it becomes much less valuable as a metric because the actual operating profit is probably quite different. So, yeah, unfortunately, I wouldn't touch it. Yeah, which is a shame because I think it used to be quite a good company when energy prices, you go back 5-10 years when they were a bit more kind of reasonable. But at the minute, it's just uninvestable.
Yeah. I think the difficulty is that the current strategy to net zero is only likely to make the energy prices higher. And when it's such an energy intensive business, it doesn't suit renewables at all to bake bricks.
Yeah, I think they just have to kind of hold out for the next few years and then just hope there's a change in policy because I can't see it in the meantime.
Yeah, and not that we're a political show, but I think it's so heavily linked to that you can't get around it.
Yeah.
On to AutoTrader then.
Yeah.
Less energy intensive.
Yes, back to tech businesses that have been damaged by AI. So AutoTrader, I'm sure it needs no introduction. It's the marketplace for buying and selling cars. They have come out with their full year results and revenue was up 4%. That was split between 4% increase for AutoTrader and Autorama, which is kind of the car financing part of the business, which is much smaller. It's less than 10% of the total. That was up 7%. Operating profit was up 4%, and that was split by AutoTrader up 4% and Autorama up 53%. I say up 53%, the losses were cut in half. However, I think next year they are actually expecting Autorama to contribute positively for the first time. So the AutoTrader operating profit margin was 70%, and that compares to a group operating profit margin of 63%. And as we discussed above, that's because Autorama's dragging it down at the minute. Earnings per share was up 8%, and the cash generated from operations was up 5%. The leverage, that's gone from 0 to 0.3x, but I don't think you really need to worry at that level. Average retailer forecourts, that was down 1%, and the average revenue per retailer was up 5%. And they've said revenue growth for the second half was 3% and lower in the fourth quarter, reflecting the more difficult trading conditions, the retailer feedback regarding our deal builder product rollout, which we have moved quickly to address. This has resulted in improved sentiment, and throughout April and May, we've seen a gradual increase in our core KPIs, retailer forecourts, volumes of paid stock, and higher package penetration. In the year, our position with car buyers has strengthened with 11 times more time spent on AutoTrader than our nearest competitor, and that compares to 10 times last year. And 6 times more time spent on AutoTrader than all our main competitors combined. Through the strength of our brand, wide selection of available cars, and the tools we provide, over 80% of buyers on AutoTrader choose to come to us directly. During the half, we returned 463 million to shareholders through dividends and accelerated share buybacks, largely in the second half. And for context, that is on a market cap of 3.71 billion. So these are really quite big buybacks, actually. We purchased 58.5 million shares, which was 6.6% of issued share capital, drawing 165 million of our debt facility, increasing the leverage up to 0.3x. So that's why the leverage has gone up. They're borrowing money to buy back shares. We're proposing a final dividend up 10% on the prior year. The board believes the prevailing AutoTrader share price does not reflect the company's fundamentals or long-term prospects and is therefore updating its capital allocation policy. We will continue to invest in the business to support growth and continue with our existing dividend policy. In financial year 2027, we currently expect to return 600 million to shareholders through 500 million of share buybacks and continuing to pay a third of net income in dividends. This returns over 1 billion to shareholders over the course of 26 and 27. For the outlook, they've said we remain comfortable with our current levels of investment such that group operating profit margins, excluding vehicle and accessory sales, will at least be maintained. Group operating profit is expected to be 395 to 415 million for the 2027 year, slightly above where they were this year, so they were at 392. With an accelerated level of share buyback, we anticipate at least high single-digit basic earnings per share growth. And in terms of the valuation, the business trades at a PE of 13.29 and has a dividend yield of 2.5. But as mentioned, the buybacks are quite significant, so the actual yield's a lot higher. I think this is an interesting one because I think those results, they're not amazing. It's basically just kind of gone up slightly above inflation, but it's already in quite a dominant position. I think the most attractive thing is probably the capital allocation policy. I actually think at this level, I think taking on debt to buy back the shares, I think is quite sensible because I think at a P of 13, we're used to seeing it at kind of 25. And I think that business still seems to be fine. I think the issue for me would be, although it's a good company, I think Rightmove's putting up slightly better results and Rightmove's also pretty cheap at the minute. So you could have both, but why wouldn't you just buy Rightmove? But yeah, I think not an amazing set of results, but when it's so dominant, I suppose you can't necessarily expect that every single year. But I think the capital allocation policy looks quite smart. My only kind of niggle with it would probably be if I was a shareholder, although I would buy into the capital allocation policy, I'd rather just see them cut the dividend. Because if I'm getting the money through share buybacks at 13 times earnings, I'd be quite happy with that. But obviously management don't like to cut dividends, so it is what it is. John, what do you think?
Yeah, I think the results were okay, but gosh, it is cheap at the moment, isn't it? And yeah, it's a difficult one because naturally, having covered it for sort of 5 years, you are drawn to it at this valuation. I think it is still a quality business. Yes, obviously it's very saturated. I know they're sort of expanding in terms of the credit side of the business. Would I add it as well as Rightmove? I don't know. I'd certainly have a think about it.
I think that's the difficult thing because if Rightmove didn't exist, you'd probably be all over it at this price.
Yeah, no, absolutely. And yeah, I guess if you look at Nick Train's portfolio, it's got both in fairly sizable chunks.
I think if you were taking like a sort of a basket of these cheaper tech companies, it would definitely be in there. But yeah, if you're just getting one, I would probably buy Rightmove.
Yeah, no, that's a fair point. And if you were looking for the basket, you might as well buy the Nick Train portfolio.
Yeah.
Or his fund, yeah. Because that's cheaper still. So yeah, fine.
Should we move on to M&S? How are they doing?
Yeah, no, absolutely. So again, we've been covering it for a few years. They had the full year results out with full year sales rising by 25% to £17.4 billion, driven by the inclusion of Ocado retail revenue for the first time. Excluding this, total sales rose 2% to £14.2 billion, with food sales growth of 7%, largely offset by an 8% decline in fashion, home and beauty, resulting from the cyber attack. Underlying pre-tax profits fell by 24% to £671 million due to the impact from the disruption due to the cyber attack. And that was across both food and the home, fashion, beauty division. Free cash flow fell from 420 inflow to an £8 million outflow, and net debt, including lease liabilities, rose from 1.8 to £2.4 billion. For the year ahead, M&S expects profits to grow relative to 2024-25 levels, and a final dividend of 3 pence a share was announced, taking the full year total to 4.2 pence a share, which is up 17%. And the shares rose 4% in early trading. In terms of valuation, M&S have a market cap of £7.7 billion and trade at 9.9 times forward earnings, compared with a 10-year average of 11, and they have a prospective dividend yield of 2.1%. I suppose these results are slightly distorted if you're just looking at the top line with the inclusion of Ocado Retail. If you exclude that, then much more modest, certainly when it comes to the total sales. Food, stronger performer, and then the fashion, home and beauty, which was the worst hit of their divisions when it comes to the cyber attack. So it's not entirely surprising, and I think that cyber attack has distorted things a lot. I think if it was more normalized numbers, then it certainly would have been a better set of figures than that. In terms of how much the cyber attack is going to affect them longer term, I think it's probably, given how many cyber attacks and how common they are, and that they still have a pretty strong brand, probably not likely to do really lasting damage. So on that basis, you could argue that under 10 times earning or 10 times forward earnings is pretty cheap. It's not an income stock at the moment. The dividend's very low at 2.1%. This kind of business, I suppose you traditionally would have expected more of a probably 4 or 5% dividend. But I think overall the business has been turned around, certainly compared with a few years ago. And that's going back with a turnaround story that's never quite materialized over, I don't know, as long as I can remember, the past probably 15 years, something like that. But it does look like it's in a good place. I think some of my concerns with it would be, well, one is just opportunity cost. Other issues I would have is that I think there are going to be issues in terms of the workers' rights bill, and that is going to cost M&S more. They're quite staff heavy, and also increased energy costs. That's another thing that they'll be contending with. And if we've got a broader kind of stagflationary environment, again, that's not going to bode well for M&S. I appreciate it's more on the upmarket end, but I think it would be hit by those headwinds. So probably not one for me.
I thought these results were actually okay, because I think we knew they weren't going to be good because of the cyber attack. But I think if you strip those out, it was actually quite encouraging. I think with that cyber attack, like for weeks, you would just go in and there wouldn't be stock on the shelves. So it was obviously going to have a big impact. I think in terms of the valuation, I think at a P under 10, I actually think it's quite attractive. So it's not one I'd buy, but if you compare that to, say, Tesco, for example, which I think probably for the entire time we've done the show has been our supermarket of choice if we had to buy one, I actually think on that valuation basis, I think it probably looks more attractive now, because Tesco, although it's done really well, it has crept up. I think with M&S, I know it might have taken them 15, 20 years to get there, but I think it now is actually turning around. I do believe they are actually doing it this time. I think we've had a few years of consistency, and that cyber attack is unfortunate, but I don't think it changes that wider trend. So you then go to the point I think you've raised that the dividend's quite low. I guess you would be hoping that that's going to start creeping up in the next few years. And, if it's up 17% compared to last year, you don't need that many years of that before it's quite a decent yield. So, yeah, I don't think it's terrible. But, yeah, I think on valuation, it probably is a bit more attractive than maybe the other supermarkets at the moment.
No, fair enough. Okay, then. On to Cranswick.
Yes. So Cranswick, we have covered them before. They basically provide meat, really, for supermarkets. So like poultry, pork, that kind of thing. They have come out with their full year results, and revenue was up 9.5%. Operating profit was up 22%. Earnings per share was up 18%. And if we go off the adjusted figures, the adjusted operating profit was up 14.5%. And the margin was up 35 basis points from 7.6 to 7.9%. Earnings per share adjusted was up 10.4%. Return on capital was basically flat at 18.5%. Net debt was up it was up quite a bit from 39.7 to 65 million. But on these profit figures, I don't think it's anything to be concerned about. And also they have been investing quite heavily in capital the last couple of years. And the dividend was up 11.4%. They've highlighted that the strong revenue growth of 9.5% includes like-for-like revenue growth of 6.8%. UK food revenue was up 9.4%, underpinned by strong volume growth of 8.3% and record Christmas trading. Poultry revenue was up 13.9% and now represents 20.3% of group revenue. Gourmet products revenue increased 15.3% with a strong contribution from Blakemans, and pet products revenue increased 29.8%, reflecting the expansion of the pets at home relationship. Free cash conversion of 120.6% reflected record cash generated from operations. Performance across all financial measures was well ahead of medium-term targets. In strategic highlights, they've said £56 million has been committed to increase capacity at the iFresh poultry facility by a further 25% by summer 27. A record £163 million was invested across the business, bringing total invested to more than £560 million over the past 5 years. Strong progress across the pipeline of major capital products, £30 million expansion of the 2 added value whole poultry sites and £27 million Worsley hummus facility fit out complete. £100 million investment in flagship whole pork primary processing site, progressing well. The new highly automated on-site cold store facility now fully operational. £40 million spent on farming and feed milling to expand and strengthen the integrated supply chain. And Blakemans and JSR Genetics acquisitions continue to perform ahead of initial expectations. In terms of the valuation, the business trades at a PE of 18.73 and trades at a dividend yield of 1.99%. I think these are outstanding set of results. Yeah, you can't really knock it at all. I think they've done really well the past few years. I think they've invested well in the capital. They're starting to sort of reap the rewards of that. I mean, quite interestingly, I used to know someone that worked at Cranswick, and they'd made the comment a few years ago that actually they'd been a huge beneficiary of Brexit because it had driven much more of a demand for kind of like British beef and British pork and stuff, which I think you are partly seeing in those results as well. But yeah, I think it's a really, really good set of results. I think at a PE of just under 19, it's not cheap, but for a business putting up these results consistently, you wouldn't expect it to be. I think if someone had it, they could make an argument for it, and it's a great business. But I think for me, it would probably be valuation. I think at a PE of just under 19, you could probably do a bit better, but that's not the company's fault. And in terms of those results, I think they are absolutely outstanding given the size of the business already. What about you, John?
Yeah, no, I would tend to agree with you. It's one that I kind of wish I'd bought a few years ago and obviously haven't. And it is, pretty expensive now. In terms of a bear case, I think if there were any future sort of deal with the EU, if there was to talk about rejoining or getting closer, whether there would be any sellout on kind of an agri-foods side of things. And that could, negatively impact Cranswick. But how likely that is, I have no idea. So, yeah, I think it's a really well-run business and it's continuing to put up great figures. So, yeah, can't knock it.
I think on the EU point, I guess my counter to that would be like when you go in the supermarket, it is all over the packaging now. If it's British poultry or British beef, and I think that in terms of the branding has become more important.
Yeah.
So that might offset that anyway, in that there's maybe still kind of a preference for British beef.
True. You're right. Well, of the companies this week, Sam, what would be your first pick and what would come last?
I think first out of these would have to be AutoTrader.
Yeah.
Probably by a distance. And there's some other good companies in there. I think last it would have to be Ibstock, again by a distance. What about you?
Yeah, without being boring, I think AutoTrader, quality company and really low valuation compared with historic levels for it. So yeah, that would be an easy first. And then, Ibstock would be an easy last. It's difficult to see where the business goes, certainly in the near term.
I think that's everything in that case.
Thank you very much for listening, and we will see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter @TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.